If you had $1,000 to invest in January 2013 and had to choose between Bitcoin, the S&P 500 index, or gold, which would have been the better decision? The answer will surprise you and might completely change your perspective on investing. In 2013, Bitcoin was virtually unknown to mainstream investors, trading at less than $20. The S&P 500 was recovering from the 2008 financial crisis, and gold was seen as a traditional safe haven, having just come off historic highs. Let's follow the journey of these $1,000 through the years, through bubbles and crashes, pandemics and market rallies, to discover which investment truly paid off. And more importantly, what this teaches us about the future. To keep our comparison fair, we'll imagine that in January 2013 you divided $1,000 equally between the three assets: $333.33 in Bitcoin, $333.33 in the S&P 500 index, with dividends reinvested, and $333.33 in physical gold. We'll consider all stock splits, dividends, crypto forks, and other events that would affect your investments. All values are adjusted for inflation to represent real purchasing power. Let's look at how each investment performed year by year, from 2013 through early 2025. Let's start with Bitcoin, which had the most volatile journey. Your $333 would have bought approximately 25 Bitcoins in January 2013, when the price was around $13.30. In 2017, we saw the first major bull cycle, when the price approached $20,000. Then came the inevitable crash, reducing your investment to about $80,000 in 2018. The 2020 pandemic initially caused a drop, but soon triggered an epic rally that took Bitcoin to nearly $69,000 in November 2021, turning your initial $333 into more than $1,700,000. The bear market that followed cut that value significantly, but after events like the Bitcoin ETF approvals in 2024 and the halving, your investment would still be worth approximately $1,620,000 today. That represents a return of over 487,000% in 12 years. Now, let's look at the S&P 500, representing the 500 largest American companies. Your $333 invested in January 2013, with all dividends reinvested, would have written one of the longest bull markets in American history. The index experienced some corrections, like in 2018, but nothing compared to the shock of the pandemic in March 2020, when markets fell more than 30% in weeks. However, the recovery was equally impressive, and technology companies like Apple, Microsoft, and Amazon drove the index to new records. After 12 years, your $333 in the S&P 500 would have grown to approximately $1,090. That represents a total return of 227%, including stock appreciation and reinvested dividends. Finally, gold, the asset that has been valued by civilizations for thousands of years. Your $333 would have bought approximately 0.2 ounces of gold in January 2013, when the price was around $1,660 per ounce. Unlike Bitcoin's roller coaster or the S&P 500's consistent climbs, gold followed a more conservative path. We saw declines from 2013 to 2015, followed by a gradual recovery. Geopolitical events like trade tensions, Brexit, and the COVID-19 pandemic boosted gold as a safe haven, pushing it to historical highs, above $2,000 per ounce. After 12 years, your $333 in gold would have transformed into approximately $440. That represents a total return of 32%, significantly lower than the other assets, but with much less volatility and risk. Now let's compare all three investments side by side. The difference is simply astonishing. Your $333 in Bitcoin would have grown to approximately $1,620,000, representing a return of 487,000%. Your $333 in the S&P 500 would have grown to about $1,090, a return of 227%. And your $333 in gold would have become $440, a return of 32%. If you had invested your entire $1,000 in Bitcoin instead of diversifying, today you would have approximately $4,870,000. But this story has important nuances we need to explore, but return is only part of the story. Let's talk about risk and volatility. Bitcoin had extraordinary returns, but also experienced drops of more than 80% multiple times. Imagine watching your investment fall from $500,000 to $80,000 in months. The S&P 500 had its biggest drop during the pandemic, approximately 32%. Frightening, but nothing compared to Bitcoin. Gold, while generating smaller returns, rarely fell more than 30%. matters enormously. If you had invested at Bitcoin's 2017 peak, you would have waited years to recover your initial value. So which really was the better investment? The answer depends on three critical factors. What does this comparison teach us? First, diversification matters. Even though Bitcoin dramatically outperformed the other assets, including less volatile investments would have protected you during severe downturns. Second, your time horizon is crucial. High volatility investments like Bitcoin work best with long-term horizons, allowing recovery from significant drops. Third, your personal risk tolerance is determinate. Not everyone has the stomach to watch their investment drop 80% without panicking and selling at the bottom. The perfect investment combines potential return, risk you can tolerate, and a time horizon aligned with your goals. As we've seen, $1,000 divided equally between Bitcoin, S&P 500, and gold in 2013 would have transformed into approximately $1,620,000 today, with Bitcoin representing the vast majority of that gain. But the real lesson isn't that you should have put everything in Bitcoin. The lesson is understanding how different asset classes behave over time and building a strategy that matches your financial goals and investor personality. In our next video, we'll compare the 5 most popular technology ETFs of the last 5 years to discover which truly delivered the best returns. If you found this analysis valuable, hit the like button, subscribe to the channel, and share with someone who could benefit from this information. Until next time,